Without a shadow of a doubt, ESG is an increasingly important area for investors. Once upon a time, it used to be known as ethical investing, but it has evolved to a lot more complexity than that. We're very lucky to have Lawrence Gosling, who many of you know, to moderate this panel. He's the founding editor of Investment Week, a former Reuters man, so welcome back, Lawrence. Good to have you back. And we have three excellent panelists. So we've going from my right to left, we have Trevor Allen, who's the product manager for BNP Paribas Risk and Performance Division.
That's Trevor. Obviously that's Jake's left, not his right.
My right to left, which is what I said, I think, Lawrence, cheeky. Chris Welsford, who's an IFA and managing director of Ayres Punchard Investment Management Limited, a specialist ethical and ESG consultant. And Andrew Parry, who's the head of sustainable investing at Hermes Investment Manager. Without further ado, I'll hand over to Lawrence.
Thank you very much, Jake. Good morning, everybody. Nice to see you all. And as Jake said, it's nice to be invited back after sort of 25 years of being away from Reuters. I obviously wasn't that as bad as I thought it was when I was here. Andrew, let's kick straight in. So, as Jake quite rightly pointed out, this is a big subject. It sort of started in ethical, probably when you started in the industry. That's what people used to talk, certainly when I started. The old stewardship funds from people like Friends Provident. It's evolved to ESG impact. How do you define it when people say to you, you know, what does Hermes see as the kind of spectrum of investments within this sort of area?
In many ways, it's actually still a sector or a set of strategies in want of a good definition. And I think we've got quite a lot of new acronyms emerging. We've got new concepts like impact investing. What for me it's about is about the investment industry taking its responsibilities to society and the environment seriously, recognizing that the way that we invest client money, the way that we interact with the companies in which we invest those clients' assets, it has a massive influence potentially on the world and the future outcomes. So increasingly, it's looking at it in a more holistic manner, not just seeing it as an isolated set of activities that you do over here, where you're going to be environmentally and socially conscious, and then over here, you can get on and be dirty, filthy, and inconsiderate. You know, so increasingly, we're just seeing these concepts of awareness of environment, society, planet, as just part of Finance 101. Who doesn't want companies that are efficient in their use of energy, their use of resources, that minimize waste, because that's part of your finance returns. Sustainability, social is then about things like staff turnover, absenteeism, reducing death and injury rates in your factories. You know, that's your productivity. And then governance, well, we all pick your favorite governance disaster, Sports Direct, Volkswagen, Wells Fargo, et cetera, et cetera. We know that damages your wealth. So while these are very much a framework for thinking about our impacts and our outcomes, it should just be integrated increasingly into the way that you think about doing the job.
Trevor, I mean, you were nodding at pretty much everything that Andrew was sort of saying there. Is there anything from BNP's perspective that also kind of falls within this kind of quite a large area of interest?
Yeah, absolutely. So I think when we look at ESG, really, this is a set of extra financial data that we can use to help analyze companies further, but it needs to be in conjunction with the financial data of the company. So I think a lot of times people are parsing through all the KPIs, and we look at ESG data, for example, I know Thomson Reuters, for example, there are 450 points of data, KPIs in the ESG data that they actually do the analysis on these companies. So a tremendous amount of data to kind of parse through. And I think a lot of times everyone is looking for kind of that silver bullet. You know, what is that one KPI that's going to tell me this company is going to outperform this company? And that can, I would say, I caution against a silver bullet. It's going to change from sector to sector and region to region. But where I think this data is really influential is where we take, at the end of the day, we're investing in companies because we want their revenues to increase and ultimately their profits. If we look at the revenues of a company increasing, and then we look at something like a carbon footprint, if that carbon footprint is increasing at the same rate or at an even steeper rate than the revenues, that represents to me an unsustainable business model for the future. And that's kind of really the signals that we're starting to look for, combining this extra financial data with the financial data. At some point in the future, that company is going to have to change its business model, whether that's changing the mix of green energy or whether it's substantially actually changing something pertinent to its everyday business model. So.
Chris, you're very much at the sort of the sharp end, the coal face, as it were. No sort of pun intended. With private clients, with sort of families. So for you, as a long-standing financial advisor, where did the journey start? Were you always interested in what was then called ethical investing, and you've sort of moved through the sort of spectrum? Do you see a difference between ethical investing and what we're calling ESG?
Well, yes, and the journey started because my own personal interests were there. So obviously most businesses start in that way. But I want to try and get my head around or try and explain the way we're thinking about ESG, because it seems to me to be dragging the conventional side of the fund management industry into something very sensible, which is just a qualitative way of looking at companies, which we should be doing anyway. ESG isn't ethical investing necessarily.
Sorry, just to cut in. How would you define ethical investing if somebody in the audience walked in and said, Chris, I want an ethical investment, not an ESG investment? How would you? Well,
the first question would be, well, what ethics are we talking about here?
Okay.
What are your feelings about things? So you'd have a very detailed discussion about ethics, and that takes a completely different line to a quant argument about what's a good company to invest in necessarily. See, the ESG argument comes from a completely different angle in my view. It's looking at, first of all, the quantitative arguments about what's a good company to invest in, and then looking at the ESG factors as an overlay, trying to work out whether that company is actually sustainable. Is it doing what it says it's doing? Is it lying to us? Are the analysts being bamboozled? Sort of Tesco's type argument. Whereas ethical is different. A good example this morning, Church of England, Exxon. I suppose it will be headlines at some point. But the point is that they're not saying just that they don't want to invest in this particular oil company because it's not going to make them any money. They're saying they don't want to invest in it because they don't agree with its ethics. And so they're different things. So if I have a client that comes to me and says, I want you to give me a great return, then I'll find a fund that's both doing good quantitative and qualitative analysis. And if they say to me, I want a fund that doesn't invest in tobacco, then that's an ethical question, and I'll do that. But of course, I'll try and find the fund that's doing its best to give a good return as well. So they are different things.
I mean, Andrew, would you agree with that? Some of the examples, I mean, Chris has picked on individual companies. I'm not suggesting you sort of comment on those. But in general, some of those, I mean, would you agree with him that ESG and ethical is different for certain types of investors?
Yes, I'd love to rant about Exxon as well, so I don't have any problem about that, because I really view that as a classic example of where bad behaviours lead to bad future outcomes. I think it becomes then an unsustainable business by promoting climate change denialists. They actually lead to potentially a very unpleasant outcome for the world. And also it means they misallocate capital. They're investing in projects where they probably won't get an economic return. So that's an example where ethics and business practice, if you take the right time horizon, come together. We try to avoid just doing blanket exclusions. The point that Chris sort of made, that one person's morals is another person's good night out. And it's not for us as investment managers to impose ethical constraints. So we have lots of clients who come to us and say, we want to invest with certain values and purposes. Will you exclude things? And we will design things. In our products, our mainstream products, we try to think of it more about, is the behavior of that company going to lead to a sustainable set of future profits and income? So, for example, I think the tobacco industry, which has been a fantastic moneymaker, is now at a tipping point where the business is increasingly becoming unsustainable over the long term. Imperial Brands have just announced figures where their sales are down as people become more and more aware of it. So for me, it's much more about integrating it into a sustainable business model thinking rather than taking exclusions, unless we're asked by the client to do that.
Go on, Trevor. Yeah.
I think on the tobacco companies in particular, not to kind of single anyone out or in that sense, but there's a great example of where you have ESG data that some of these tobacco companies have very high ESG scores. And if you look at a lot of the ethical indices out there, they have very high scores. So if you're looking from an ESG perspective, you could sit there and say, this is a perfectly reasonable investment, because some of these tobacco companies have had, over the last 20 years, have returned 5 times as much as the S&P 500. So it's definitely a profitable investment over a long-term period. We've seen that with the dividends. But on top of that, you can actually justify it through some of this ESG data. So it's very dangerous to kind of, companies understand if they have a quote-unquote vice product, they have to start paying attention to their ESG scores more. So it's not enough to just kind of look at the ESG score and take that at face value.
That is exactly the point I was making, because the end result of that is that we engage in very dangerous marketing. And we have potentially companies badging funds as ESG funds, which are then sold as ethical funds. And that's not correct.
So I'd like, might take disagreement or raise a concern about the view.
Disagree. It makes a good, much better panel.
Do you want me to be polite? Or?
No, you don't have to. Just be polite to me.
No, but I do have a worry about the data, and I think the tobacco companies is a perfect example of companies recognizing that the more data points that you put out in ESG, the better the score you will get, and the more likely you are not to be deselected by ESG or ESG integrated. And definitely when you look at some companies, you might find a company that's very environmentally friendly and thinks, oh, well, I do what I do, we're really green, and they don't think about scoring and putting all the data out. I tend to find that the ones with the most challenged business models, gambling, tobacco, things like that, are the ones that have done the most work to get the most data out there so they get the highest ESG score. That doesn't mean for me that they're sustainable or responsible businesses. It just means they know how to play the system more efficiently than others.
I think we're in agreement there. In terms of the ESG, and that's what, Chris, I think you were saying, that you need to dig deeper there because they are putting that data out there as a marketing tool.
But there's a danger that some people end up with tobacco in ESG funds because it becomes then best in class for that sector. And tobacco is tobacco, no matter how you dress it up. And then if you look at how much they lobby to keep perpetuating an illness, a product that obviously kills people, then you have to recognise that challenge.
I think the problem is that this has become a big bandwagon, which companies can see is going to be very, very popular. And that's why we're getting this, in my view anyway, a big flood of movement towards what people are trying to call SRI or sustainability, but they're also going down this ethical route, and I think that is dangerous because ethics is complicated, and there are companies employing philosophers these days to deal with ethical issues, and that's because it is a very complex subject, and if we confuse it too much, we could end up in a real mess. And we could end up in a regulatory mess as well, because people will be investing in funds which they think are one thing and are actually something quite different.
Okay. Has anybody got any questions before we press on? I'm very conscious that I'm sure you've all got opinions on this. If anybody has, put your hand up. If not, we'll sort of push on. I mean, Trevor, you mentioned the performance issue there, and it's kind of interesting. I think if you look at the S&P over a sort of long term, tobacco and alcohol, the two best performing sectors, and as you said, tobacco's been one of the best performing sectors. Is there a danger? Because firstly, I think a lot of investors who are not particularly exposed to this sort of say, I've got to give up some performance for having some form of ESG sort of criteria. How do you address that as an issue if people say that to you?
I think it goes back to what you're trying to limit in your portfolio. So for example, some of the experiments we've done, and this is back tested as well, but carbon footprinting, for example, we were able to take, if we just look at kind of the MSCI All-World Index and take out the worst polluters in there and keep the indice balanced the exact same way, but then basically trade out on a sector basis companies with a lower carbon footprint for companies with the worst carbon footprint. we actually were able to track the industry within 1% and reduce the amount of carbon footprint for the portfolio by 63%. So I think you can have a bigger impact than you realize and still track these portfolios. It just comes down to what is the impetus for you? A lot of times we see with tobacco, people divest from tobacco and then they go into alcohol.
Yeah.
So they've kind of gone from one to the other because they're similar performing stocks in that sense. Or sometimes you leave alcohol and you go into gambling in that sense. So I think there's a bit of a rotation, which vice is least worse for you in that sense. But I think over the course of a portfolio, you'd be surprised how much of kind of these ethical quandaries you can reduce, but it's very personal to you and how you want to do that. So I would focus kind of internally on which ones are important to you and look how you can kind of rotate your sector allocation on that.
Now, Andrew, Hermes does the sort of responsible capitalism sort of research on a regular basis. I think the last one sort of said kind of, about 50% of the respondents actually thought performance would be, quote, sort of worse or not as good using sort of ESG factors. Again, how do you respond to that when you sort of talk to people about the investment outcomes that they can get from this kind of sector?
Yeah, well, whether we're responsible, impactful, sustainable, ESG, whatever approach, we have to remember, first and foremost, we have to be good investors. So, we mustn't never lose sight of that. That is, if you like, our much quoted fiduciary duty. But it's the sort of the prism, the lens through which you look at the universe for opportunities. And I think sometimes we get too fixated on tobacco and tobacco's historic performance as an example of why excluding or not being responsible or sustainable is bad for your performance. But what we forget is, I'm old enough to remember the tobacco in the 1990s, and it was not a very good investment. Actually, everybody bases it from 2000 when they were trading on 6 times earnings. For example, BATS was trading 1 times EV to sales. When it peaked last year, it was trading at 8 times EV to sales. Our job, our really basic job, is to buy stocks when they're cheap and sell them when they're expensive. Just because something's done very well for the last 15 years, which is driven less by the industry, more by bond yields falling. There's a really high correlation between the valuation of tobacco stocks and global bond yields. And so really, when you're buying a tobacco stock at today's valuations, you're taking a view on future bond yields and the direction of them. So from a factor perspective, which is why Trevor was right at saying there are other substitution effects. We would say, though, it's sometimes a matter of time horizon. If you're going to look quarter to quarter to quarter, you're going to miss the big picture. You're going to miss emerging growth opportunities. I think we'll probably talk about things like the Sustainable Development Goals. So, these are an overarching framework agreed by 197 countries around the world as a framework for eliminating global poverty and inequality by 2030. So, huge overarching ambition to do some great things in the world. There are 169 targets within the 17 goals, and those actually map to the activities of companies. So another way of looking at those sustainable development goals is actually representing this huge future growth opportunity. These represent the underserved or unmet needs in society. So instead of thinking about sustainability and things and ESG as removing negatives, think about it as actually looking at the world in the next 15 years as a set of fantastic growth opportunities of undiscounted, unrecognized, emerging growth opportunities. And then if you do that as an investor, I get very excited about that. Because that's looking towards the future where people are very inefficient at discounting emerging growth opportunities. And that will also be doing good and helping transform the world, we hope, or at least making it more resilient and pushing back against some of the negative political forces that we're seeing build up in the system.
And Chris, as you're looking at it from an investment perspective, with private clients, do you look at it very much in the way that Andrew's described? These are long-term investment opportunities.
Yes, and I would expect investment managers to be taking ESG factors into account as a matter of normality in all funds, conventional funds, not just funds that are badged ESG, because if you're not doing that, then you're not able to look at a company and work out if it's sustainable. You're not able to work out whether it's lying to you. It's not possible to do any of those things if you don't investigate those three subjects. And it seems incredible to me that anybody would say, that taking an ESG approach would damage your returns. It's got to enhance your returns, otherwise there's no point in doing it.
So why? Playing devil's advocate, why would you say? Yeah,
because you'll understand more about the company, you'll understand more about its environmental, social and governance factors. That's all they are, they're factors. They shouldn't really be a style of investing, I think. I think that once you've done your financial analysis on the company and all the things that you should do to work out whether it's a financially viable company now, or appears to be, then the ESG analysis will allow you to understand where it's going to go in the future, exactly what Andrew's been saying. And isn't what we do all about sustainability anyway? It should be about creating sustainable income flows for our clients and sustainable growth prospects, not here today, gone tomorrow. I'd just like to say something about tobacco, because I'll probably go back as far as you and maybe a bit further, I don't know, but back in the late 80s.
Competition to see who's the oldest.
Yeah, who's the oldest? We were using tobacco as a defensive investment because it rides the troughs. So that's what it used to be, and it changed, as you say. You know, it became something more of a money-making project. I don't know. I think ethics is different to ESG. Because when you start to think about the ethical considerations, these are what upset clients. So I'll give you an example. I go to see a brand new client, introduced to me by an accountant. I sit with her and her son, and we look at her portfolio, and she says, "I've never seen this before. Your advisor didn't show you what your even top 10 stocks are." And there were 3 tobacco companies there. And she said, "I hate tobacco companies." Now, it's an example of her ethics. Or somebody else would say, "I love tobacco companies." I wouldn't probably want to be in the room with him at the time, but that's the point about ethical investing. And it's different because you should be able to select stocks which would at least do the same job as those tobacco companies, but aren't tobacco companies, maybe utilities or something like that. That's an ethical matter. That is not to do with ESG, which is an analyst looking at a company and saying, is it an environmental transgressor and is it going to cost me money because of that? Is it causing me lots of problems with employment disputes? So is it going to cost me money there? And how's its governance? Has it lied? Does it tell the truth? Is it transparent? Was this an opaque company and I can't actually get to the bottom of what they're telling me here? Those are questions we should be asking for every company, not just in an ethical context.
Trevor, let's pick up on the issue of governance, as to sort of raised a couple of times. It strikes me it's probably one of the harder factors to spot from data points. Clearly, if a sort of company's lied, let's pick a sort of Wells Fargo type sort of scenario. That's kind of pretty obvious. And again, Andrew mentioned Sports Direct, and I think they're never going to win an award from corporate governance currently. They're obvious ones that are out there, and but there are sort of more subtle. And what are the factors you can look at that you can get from the data points that gives you an indication?
So I think shareholder rights is really an interesting one because we've really seen a transformation, in particular in Silicon Valley. There's a bit of the cult of personality factor there, where people put a lot of faith in a single CEO. Yeah. And we've seen recently, I don't think it's over a year old now, but Facebook in particular, they've changed their share class structure. So there's a founding share class of stock that has 10 voting rights for every single share of equity that they actually hold. This is a fundamental change in terms of governance because now, as an equity investor, you have no influence in that company really. Like you could, no matter what Facebook wants to invest in the future, you're not going to be able to influence them in that sense. So is that important to you as an investor? Do you want to have those voting rights? Or is it literally that you're putting your faith in the CEO and that you agree with their vision of the future? So I think shareholder rights are going to be increasingly important for the future to really understand the governance factor and if you're going to have any influence on that company. So.
Just to say, I think governance is a hugely important area, and it's actually somewhere that when you're investing, you should be always asking your portfolio managers, are they exercising their rights as your representatives in voting? You know, increasingly we need to engage with the companies of which we're stewards of to make sure they're doing the right things. And I think that's one of the changes in the industry that we're beginning to see, that more people are beginning to take seriously their responsibilities to exercise their vote on behalf of clients. And particularly that's true of index managers. So if you're a passive investor and all you do is replicate the index, and that's great because it gives you access in a low-cost way to beta, then the only thing that the investment management company can do to change outcomes is to actually engage with the company and exercise votes, and always make sure that what the company, you know, the investment manager is saying at a public policy level is actually how they vote with your client assets, because they don't always vote in the same direction. So I think there needs to be a lot more public scrutiny and a lot more bottom-up, you know, demands from people investing in unit trust, UCITS funds, DC schemes, DB schemes, to actually say, we want you to take these issues seriously, and you have power to engage with, through the size of your business, the size of your shareholding, and the votes that come attached with it, obviously a few exceptions like Facebook, and make use of that, because you can change outcomes. And I think that's very, very important, and don't think that bad governance doesn't matter when the share price is going up. You know, Facebook has more than just its voting problem. It enabled Donald Trump to get into the White House in many ways by its uncurated use of information. So these things will come home to bite the companies. We never know when. So bad governance is always like a factor that's in there. It's a threat, but you don't know when it will happen. So Sports Direct, Panorama's program, I think, and the Guardian articles were 2012. And investors generally ignored those problems until the business went ex-growth in 2016. And then what you had? Bad growth and bad governance collided for the stock to fall 75% peak to trough. So never underestimate why bad governance will destroy wealth.
Chris, just before you come in, I mean, sports rates are interesting, because anybody who'd ever visited the store before the company floated, you know, you wouldn't have had the best impression of it. I fail to understand why large institutional shareholders support an IPO of a business like that and then 2 years later grumble about corporate governance. Is that one of the issues for the industry?
I think it is, and you know, Facebook and the tech companies are perfect examples of that, because they're in many ways they're immature companies, in that they're immature in the sense that they're still entrepreneurial companies. They haven't put in the governance structures of going public. They're public for their own convenience and for, you know, to monetize the wealth of their founders. So, and you think of, go back to Microsoft. So Microsoft ages ago had the same voting problems, and it had a dominant, you know, CEO in Bill Gates. When they went ex-growth and the shares tumbled, so then they realized they needed to put in place proper governance, proper voting, a proper board structure. So these things do come home. But where investors get phased is they look at the growth in the short term, medium term, and go, oh, it doesn't really matter. I know they're really bad. I know Volkswagen's board structure and governance is really appalling, but it won't, you know, it's doing well, so I can ignore that. And then you get a scandal, and you go, yeah, oh dear.
This is
Chris,
where fund managers are letting investors down, because they're not, in those examples, doing that work. And that should be, as I say, just a normal part of the analytical process, not something special.
And when you're investing your client money, do you look at the voting track record, for example, of the management group?
Yes, and we'll go to, I've been to visit managers and have those discussions with them. I feel very glad that I can do that, because it should be part of the IFA's role to certainly investigate those things, and if they're investing in that way, then they should be going to see the fund managers and talking to them about those things. But that's often been restricted to just the ethical side of things. It's becoming much more the case now that we do that. But I wanted to just say something about engagement, because we've been talking about engagement, and I have very strong views about that, because the industry uses engagement very often as an excuse to invest in companies which I consider to be would fail an ESG screening, in my view.
What sort of companies do you think?
Mining companies,
okay,
for example. Mining companies are important because they give us exposure to commodities, and it's difficult to exclude them. And I've tried. We've used discretionary fund managers we talk to them about how to create a portfolio that's specific and bespoke, and we end up with, well, we've got to have some miners because we need the sector, and we have to have some oil because we need the sector, and it's always we have to have that sector represented in the portfolio, and that's a difficult one. If your customer has given you a human rights mandate, for instance, and says, I do not want any human rights transgressions, then mining companies are very difficult to put into your portfolio. And the use of engagement to justify the inclusion of mining companies, because we're going to make them better, has been proved to be false. So we've got to be very careful with engagement. Mining Watch Canada, for instance, I mentioned it. We talked about it 3 years ago, and the research that they've done using academics who've gone out there and done the job very, very well has shown that Canadian mutual companies engaging with Canadian mining companies have become assimilated into their way of thinking rather than the other way around. So engagement's been counterproductive. So I think if we're going to do these things and tell clients that's what we're doing, then we need to be careful.
Trevor, I just want to come back to the performance issue because it's kind of interesting. I don't know whether there's any clear academic work that proves the ESG factors in the broadest sense are actually contributing to certain sectors' sort of outperformance of the broad market, or whether that's just a question of flows of capital moving towards those kind of companies because the ESG factors are becoming sort of more dominant. Do you have a sort of view on that?
Yep. So one of the things we've actually done recently is we had an ESG survey, and in this survey, it was a global survey over 462 respondents, asset managers, asset owners, sovereign wealth funds, and we saw that over the next 2 years, it was over 51% of the asset managers and over 50% of the asset owners saw that there was going to be 50% or more of their assets invested directly into ESG or SRI style funds. So there is a tremendous amount of money that's flowing towards these. So it is causing some confusion or static there in terms of what is the actual performance. Is it inflows? Is it actually how well these companies are being run in that sense? But I would say that this goes back to kind of combining the extra financial data with the financial data to really start to see the signals about sustainability. ESG is a good risk indicator. So obviously we're talking about governance. If companies have a low governance in relation to other companies in their same sector, that should be a red flag there. That's an immediate one. But also, I think this is more, when we were talking about ethical investing, more about sustainable business models and understanding what that is going to hold for the future. And I really think, Andrew, you kind of picked it up on the SDGs, that the SDGs are going to be the next decade's great investment opportunity. Everyone's always kind of looking for that. And we look at ESG scores, we're often looking at what a company is doing today or even historically. The SDGs give us the ability to look forward, and they even give us a horizon, because we know 2030 is when we have to reach these goals. All of the SDGs have KPIs inside them. So if we look at 10, I believe, is renewable energy or clean energy, 13 is climate change. One of the KPIs for 10, for renewable energy, is to substantially increase the amount of green energy in the world energy mix by 2030. So we have a time horizon, and we have substantial. We don't have a target, but we have substantial. If we look at the IAE today, less than 14% of the world's energy comes from renewable resources. So we can sit there and say if there's a substantial increase, if that's a doubling, we're looking at a 28% of the world's energy coming from green resources by 2030. There's your business opportunity. There's your investment opportunity.
Andrew, let's just sort of move on. We've got about 7 or 8 minutes sort of left, so we keep on sort of track. The kind of the active versus passive debate, in a sense. You know, you as a group run active mandates. Obviously, BNP have got some passive as well as some active as well. Again, if you're talking to a potential client about a solution, how do you sort of figure out whether an active way of running a portfolio in this space kind of can work to their needs?
Yeah, and I see both active and passive as very legitimate tools in creating portfolios. It's about what you're trying to achieve and the outcomes. Within the active space, and increasingly the way that we're doing it is just as an integrated approach in looking at this is just what you do as part of the pie chart of inputs into looking at a company. Why wouldn't you do that? So it's no longer a case of justifying why you do ESG, it's why the heck you wouldn't do it. What we then have found with some of the points that Chris has made about the sort of purpose of portfolios is the new products that we're designing and some that we're about to launch that I'm not allowed to talk really much about, but is really beginning to take that SDG approach and say, look, if we're going to be active, I want to be really different to, say, an indexed a fund that BNP or others might run. So, you know, really concentrated, where I don't need to worry about exclusions and ethics, but I'm not going to buy those companies because they're not purposeful and mission-led. They're not about the future. They're not about emerging growth opportunities. They're about the past, and I'm not interested so much in the past. I want to find out what's going on in the future. And the other thing that we find that is important with active in this area in particular is long ownership periods. You know, most of our funds have an average holding period of 4.5 years. If I'm looking to be more impactful in the way that I invest to try and meet the SDGs, or the companies in which we invest meet the SDGs, then you're looking at a really 5 to 10 year time horizon where you're trying to be aligned with the capital allocation and growth prospects of the individual companies. And, you know, moving well away from trading quarterly numbers. You want companies with much better disclosure. And then you have to have a really strong narrative about what you're trying to achieve. And in portfolios like that, I just naturally found I would never own a miner. Not because I have a thing against miners. You know, I have a car that I think is made out of metal. You know, I do tend to fly places. So let's get real. You know, these fossil fuels mining companies are part of our lives. We just want them to behave better. But that's not, for me, the opportunity. The opportunity is more in these emerging. So, you know, just mentioned alternative energy. For every dollar invested in fossil fuels globally last year, there was $2 invested in alternative energy. That transition's underway. Some countries like Denmark produce more than 100% of their needs from alternative energy on a daily basis, and Germany's up to 50% on many days. The transition is happening, so that's the future. Don't look at these people who are stuck in the past because they're misallocating capital.
And Trevor, I mean, what's the case for a sort of passive index type approach? Is it one about, as an investor, managing your risk because you know the constituents of the index and you can take a very clear view as to whether that is the right index for you? Is it that?
Yeah, so I think they're twofold. One is with the kind of the smart beta analysis today, you're able to combine a lot more factors and really kind of target in on what you want with a relatively low cost base there. Yeah. So you can have a pretty tailored portfolio, but still have it through a smart beta analysis that it's going to be tracking index pretty close, but you don't necessarily have that kind of individual investment analysis there. I think the other thing though too is it's important, there is no overarching regulation out there that's going to tell you what is a good ESG portfolio, what is a good ESG score. So you need to start benchmarking these. So to sit there and say, you know, I'm going to take a stance that I'm not going to invest in tobacco or I'm not going to invest in oil, and then you kind of have to weight yourself against an indice. So it's a good way for your passive investments to get an idea of where you're actually tracking your benchmark, but also where is your ESG outperformance? Is it coming from your sector allocation, or is it actually just coming from the fact that you're using these smart beta analysis pieces to kind of pull out the KPIs that are going to be most important to you defining your investment strategy?
Okay, gentlemen, we've got sort of 3-4 minutes to go. So final sort of thoughts. Quick one, picking up on that then, Chris.
Well, I just think that I wanted to talk about the passive versus active actually just for a moment, because I think it's really important, because it is difficult for passive investors to construct an ethical portfolio. First of all, that seems to me a big challenge, and from an ESG point of view, you just hope that we're looking at that for any companies that are involved in the index anyway. And if we've got a particularly poor ESG score for some reason, then we should exclude it perhaps. But in terms of wrapping it up, well, yeah, from a retail investor's point of view, it's about information. We run a ESG ethical screening project in-house, and we look at as many of the companies that we're invested in as possible and try and find out about them from our perspective so that we can inform our clients, and then they can make decisions about whether they want those companies in the portfolios or not.
Okay.
And that's where we
Lovely.
come from.
And Andrew, Detlef and Jake are going to talk about sort of fund flows. In the sort of UK, the fund flows in this space are pretty small in the round, about sort of 3% depending on how you cut it. When we have this discussion in 5 years' time, where do you expect the trend to have carried on? Up, I guess?
Well, if you judge it by the number of conferences and talks that I've been doing, then it's going to go exponential pretty quickly.
Yeah.
I think we are beginning to see some very large flows. I think we are looking at new areas. So my strapline is that sustainability is not an option; it's an imperative, and each of us has this complex series of impacts, both positive and negatives, as individuals, as companies, as investors. And what we want to really try to do through as much about advocacy and shouting about our purpose and preferences is to shift the system. We need to minimize those negatives as much as we can and reinforce those positives. And the investment industry has a whole huge role to play in influencing the world and the outcomes. Because let's get real, there are a lot of very negative things going on in our climate and our planet. And if we don't take action very, very soon, the outcomes are going to be quite unpleasant within our lifetime.
Trevor, final takeaway from you?
And I would say we talked a bit about these factors being kind of a normalization in the process, that they shouldn't be necessarily focused on. But I do think that conferences like this and labeling portfolios such as ESG or SRI or SDG focused are important right now for this generation to kind of really focus on these, for the next generation to kind of just have it intuitively mapped already. But I think we need the focus now to make sure we get to that next step.
We've got. Anybody want to squeeze a quick question in before we sort of round up? Gentleman right at the back. I think is there a microphone coming your way? Maybe
Thank you.
Yes.
Good morning. My name is Werner Kranenberg, and I'm a lawyer, which prefaces the question. You talked about engagement and about voting. My question to the panel is, how do you use your shareholder rights to enforce them through the courts, through shareholder litigation? The panel used Facebook as an example. There's an example there of a successful case enforcing shareholder rights recently, and also dual classes or multiple share classes. There's cases about that as well there, where shareholders successfully prevented the creation of multiple classes. So my question is, how do you use your rights through the courts?
So Chris, obviously you can't really use your rights. You don't have the resources. So just quickly, how do you exercise your own and your clients' interests?
I'll go to the fund manager, I'll sit down with them and I'll explain what my clients are trying to achieve, and I'll highlight any issues that we've found within our own analysis of their portfolio.
Okay.
That's how we do it.
Lovely. Andrew, I mean, has Hermes resorted to courts yet?
Well, not directly ourselves, because remember, they're not our assets, they're our clients' assets. So we will work with our really big asset owners to see if they want to go through that. For example, we run money for one of the largest pension funds in California. I've just put them in touch with Client Earth to see about whether there's a mutual alignment of interests there. What I do slightly disagree with Chris on this is that we do think engagement can happen and matter, and before it gets into the public domain. So a lot of these things are about trying to lobby companies before it gets to that critical point. But I think you will see far more action around climate change and a lot more of the industry in general, because it's got to be driven by the asset owners. Because ultimately we can't engage them in legal action unless they really want to. So, but I think climate change and using the law to enforce it, as we find that I think the Client Earth are suing the UK government on the Climate Act at the moment and not following it through. So I think that will be something that we increasingly talk to our clients about recourse to.
I should just say that I wasn't saying engagement wasn't a good thing. I think engagement is a very good thing, but we need to be very careful that we're doing it and not being that it's not counterproductive.
Yeah.
So, and just finally, Trevor, to Andrew's point, maybe the legal course is way down the line, and active engagement, whether it's behind closed doors or sometimes increasingly we're seeing asset managers sharing their views in the media as well.
Yeah, I think the media is an important tool, but I think it's also, we now have the technology to be able to actually go out and really understand what the individual investor wants, and we're also seeing individual investors becoming more activist and actually being interested in what their pension fund is actually, where is their money being invested. So I think the combination of that, one, it's a way to differentiate yourself as an asset manager to actually go out to your investors and sit there and say, this is our stance as a bank. For example, we've recently have announced that we're not going to invest in tar sands anymore. So when investors come to us, they have that kind of that thought already in their mind, but it's important for us to kind of engage with them to see where their ethos lies in terms of that, and then represent them as best we can.
Okay, lovely. So I'm afraid, sir, we have no work for you currently on that front. But thank you very much for your questions. A very good one. I think it's probably time to wrap up. So my thanks to Andrew, Chris, and Trevor, and from me, I hope you enjoyed that. Thank you.
Thank you, Mark.